All right, we are live and direct every single Monday, generally at 6 p.m. Pacific Standard Time. This week, I'm coming to you live at 3 p.m. Pacific Standard Time. Mortgage, real estate, the market, really anything that you have questions about, I'm happy to answer. We've had phenomenal conversations about mortgage, about the real estate market, about investment properties, about all things that I may have insight into. And week after week, I've had people come back. This week, it's 3 p.m. Pacific Standard Time. We'll see how many people show up. Hopefully, we get at least a couple dozen so we can have some good conversations. It is my wedding anniversary, taking my lovely wife to dinner to celebrate 13 years married. We're going to bring our two lovely kiddos. And so that's the reason we're doing 3 p.m. Pacific Standard Time. So hopefully it doesn't throw too many people off. I've got a 6 p.m. on the calendar every Monday, and that was the last 12 weeks or so. And so looking forward to chatting. I, in previous videos and previous live streams, have talked about inventory and how I felt before stats had even hit the paper that we're starting to get more inventory in the market, that it might be, in next month's data when we finally see it, but I've felt that the inventory is coming, and I asked people on YouTube across the nation to let me know about their market. I think we're seeing similar stuff across many different markets. Calculator risk, I was trying to see what I could find on weekly inventory numbers, and they had an article out that I didn't really get a chance to read, but basically housing inventory week over week has increased. And I see it, I feel it in the neighborhood I live in, where I actually get updates on listings coming on. I'm seeing more stuff. And so hopefully it is a sign of things to come for all the buyers that are out there trying to buy. There's plenty of demand on the demand side. Now we just need an uptick in supply. So these folks aren't competing against 20 other offers. And so I will definitely keep you updated on that. I'd love to hear what people are seeing, feeling, and hearing in their markets across the U.S. because it's hard and it will continue to remain hard. But if enough inventory comes on the market, the extremely difficult is going to turn into competitive, relatively competitive, right? And so thanks, Mona. I appreciate you joining, and I'm guessing the congratulations is on the wedding anniversary. And so, lucky guy, married up, great wife that's supportive of, long hours being worked in the mortgage industry. And as much as I love YouTube, I love the live streams, I love all this interaction, family first, and wifey definitely comes first. So we had to just adjust this time today, come on 3 hours earlier for folks that are on the West Coast like me. 3 p.m. maybe early for the East Coasters that are joining. It's already 6 o'clock. You guys should be off work, enjoying your whatever you do post work. Sit down and have a drink or dinner and whatnot. And hopefully we can jump into some conversations. I want to talk about the inventory stuff, and I love just perusing articles, because then I can see what other people are reading, right? Because more often than not, some of the clickbait titles or some of the articles I see are meant to drive traffic, but they're not necessarily an accurate depiction. If they are, they're misleading and they're stretching the truth at the very best. So this one from the National Association of Realtors, I do not believe these stats. I do not believe that 25% of purchases are cash, all cash sales. Maybe so. Man, that just seems so high. The stats for Sacramento County, where I'm at, it's like 13%. And so I don't know what markets people are buying all cash a lot higher to drag that average up. But usually if you look at a market that's, Sacramento's not a small market, it's going to be a pretty accurate reflection of what we are nationally. But 25%, cash buyers. That's bonkers. All right. Pacific Northwest, more homes are listing, but list prices are 25K higher than they were. Yeah. And that's the thing, Miss Taylor, is that number of factors contributing to people finally listing their homes for sale. They're vaccinated and they're not worried about people coming through their house or whatever. But then some people start seeing, oh my gosh, my neighbor sold for $775. Maybe I should sell my house because we've wanted to move to Nashville, Tennessee for a long time now. So let me sell my house in Seattle for $800,000 for 1,100 square feet or whatever the heck it is, right? And so yeah, this is what I think I'm seeing and feeling in a lot of places. Exactly what you said here. The overbidding is not to the extremes that they were earlier in the year, and that would be a function of more inventory, more to choose from. And I think to a certain extent, buyers are, I don't know. I just feel like it's less frenzy now. I feel like even a month ago or 2 months ago, it was a little bit of like panic and I got to get something right now because nothing's available and it's, near impossible. And now as more stuff comes on, hopefully buyers like, okay, there's 12 homes for sale in the neighborhood I'm looking, not 3. I can take a look and maybe I like these 2 and these are the 2 that I might consider putting offers in on. But when there's only 3 and everybody's looking and that's the neighborhood they want to move into, 20 offers, 27 offers, 34 offers on those 3 houses. And then it drives the price up. But like you said, the prices are still 25% more than they were 2 months ago, or 25,000. I'm sorry, not 25%. That'd be some nice month over month action. Maybe 25% more than they were 18 months ago, but 25,000 more than they were a few months ago. But if in May, there's a little bit more inventory, and so the place gets 7 offers instead of 20, and it goes for 25,000 above ask instead of 50,000 above ask, then maybe it goes, relatively speaking, it's we're not going to increase as fast, and we're going to have more of a chance as buyers to get an offer accepted. That's my my feeling. Like the last year, where whatever market you're in, where you look at year over year numbers, 12%, 14%, 16%. I'd like to think that the second half of 2021 is going to cool a little bit, where when the final tally is tallied, 2021 in total, there might be an 8% home price appreciation as a national average. Be a little bit healthier. And then 2022, maybe 5% healthy, versus just unsustainable year over year price increases that just make it really hard for lots of folks. This is an interesting question. Oh man. What's funny about this question is Meet Kevin, who most people who are on YouTube know Meet Kevin. He interviewed the CEO of United Wholesale Mortgage, a company who I do a lot of business with. I've sat on their advisory council. I've got a relationship with Matt Ishbia, the guy he interviewed. Great guy, friend of mine. I've actually got a call with him tomorrow. And this question was asked by Meet Kevin about forbearance and how forbearance affects lenders. Matt Ishbia is the CEO of United Wholesale Mortgage. It's going to do $200 billion in mortgages this year. So they do a lot of business. And so Meet Kevin's saying, you guys have to eat the first 4 months and then the Fed steps in and handles the rest. How is it going to affect you? People going into forbearance. It's not such a large number that it's necessarily hurting. But this specific question was asked, and I get people asking me this question with, hey, can I buy a home and then go into forbearance for 15 months? Some lenders have verbiage in their closing package, and they talk about you not being able to go into forbearance. I haven't seen it, and I don't think UWM has it in theirs, and many people don't. So I guess the answer to your question is it's probably not quote unquote illegal. You would I mean, you're qualifying for a mortgage. You're showing that you're able to pay the mortgage. You'd probably want a reason for there not to be any, backlash for you, because mortgage companies should make you show something or a test at the very least. A testing penalty of perjury or whatever that you've had a loss in income, a decline in income, for some reason why you need the forbearance. I see where you're going with it, and I can't say I blame you, right? You want to spread that thing out to 40 years. Somebody commented earlier on one of my videos that they've already seen a couple companies that are offering 40-year mortgages. So maybe you don't have to go into forbearance to get this 40-year loan. Maybe 40-year loans are coming. And I'm not saying that lenders that I work with have started to introduce them, but if a few lenders introduce them and they're popular, rest assured, everyone else is jumping on the train. You don't want to lose market share to other lenders because they've got a product that's popular and you don't have it. So if I were to guess, I just would think that the 40-year mortgage is coming. I wouldn't be surprised. And it would only make sense that if you're going to offer 40-year mortgages to people who are coming out of forbearance, offer them to the people who are responsible up front. And I'm not speaking on whether 40-year mortgage is a good idea or a bad idea. It might be a bad idea for some people because you're going to pay so much more interest and so little principal for the first 20 years that it's not necessarily a good product from a financial standpoint. But you know what else is going to happen too? If they come out with 40-year mortgages, it's going to further drive up demand and prices. So this is scary. Be careful what we ask for, right? Oh, you know what, Theo? Somebody else asked me about this. This is 1,000% bullshit. This is 1,000% scam. Like, claim your escrow money. Somebody sent me something, and I want you to, Theo, if you could, find information on this and send it to me, because I'll research it. Access funds through your promissory note and like 10 times. Like, this is 1,000% a scam. 1,000. I guarantee it. There's like, you're paying money into your escrow account, which is then being paid to the county for your taxes and the insurance company for your insurance. There's no secret pool of money anywhere. You put in $3,000 and then 2,000 goes to taxes, 800 goes towards your insurance, and there's 200 left. And then it's like, it keeps getting added to escrow and then paid out, added and paid out. You refinance or sell, you get that money back. There's no secret pot of gold at the end of any rainbow. So whoever is talking about this on YouTube is a flaming pile of poop. And maybe I'll find a video and tell them as much. Yeah, I'm going to get passionate if people are trying to screw consumers, because that's something that I do not like. Answer to your question, Theo. Yes, I own UWM stock because as a company, they are the best of the best. The culture's the best. The technology's the best. Upper management, who I've interacted with because I sat on an advisory council where, as a broker who sends a lot of business to them and other wholesale lenders, they want feedback. How do we do better? How do we improve? And so from Matt and all the executives I've interacted with, I just have a really strong feeling this company will continue to be super successful. And when I talk about number one wholesale lender, $200 billion this year, the second wholesale lender, and when I say wholesale, they don't do anything direct to consumer. You have to go through a broker to work with them. And so even the other lenders who are broker and retail, like, I think they do 1/10 of the volume. Maybe second place does 1/4 of the volume now. I haven't looked at the numbers recently, but not even close. They're really good. So yeah, I think if anybody who doesn't know about UWM versus Rocket, I'll give you a quick 2-minute synopsis. Rocket Mortgage is always has been like this, but they've got their wholesale channel, where brokers send them business. And they've got the retail channel where they've got big call centers in Detroit, Michigan, and they do stuff direct to consumer. You guys have all seen commercials, and you guys have all, click button, get mortgage, however they advertise, right? And the problem that UWM has with Rocket Mortgage, the problem that brokers have with Rocket Mortgage is they take all the loans that the broker, like me, sends them and all the stuff that they get direct to consumer, and they have a bunch of data and a bunch of people, and they get those people into their system like most companies do, right? It's just a common thing they do. And they continue to market to these people, and they charge them higher rates and higher fees because they're already in the ecosystem. And what kind of put it over the edge, where UWM just said, we've had enough, was Rocket started going to realtors and saying, we will pay you a referral fee, send them to us on the retail side. So the real estate agent is going to get a little bit of a kickback to send the loan to Rocket. Rocket's going to charge the consumer more. So the consumer is going to pay more, but the short-sighted realtor is going to get a little bit of kickback. That should not be legal. I'm not allowed to give kickbacks to realtors. No lender is allowed to give kickback to realtors. Quicken's a big enough player. They've got deep enough pockets where they can write stuff and have lawyers that have a lot of money. Somehow they're getting around RESPA. They're getting around that. But what UWM said, similar to how Zillow is collecting information trying to put a real estate agent out of business, Quicken is collecting data and clients and trying to put brokers out of business. And UWM said, listen, as your partner, we don't want you to feed that monster that's trying to put you out of business. If somebody stood up to Zillow, and if National Association of Realtors had the big enough huevos to do it, they would do something similar and say, listen, we're not going to pay Zillow $300 a month for leads and feed the machine that's trying to put you out of business, realtors. But they just blindly keep throwing money at them. So that's longer-winded version that I was trying to give. UWM said, listen, if you're going to send business to Rocket and fund that, we don't want to be part of it. You can't send business to us anymore. If you side with us and you want to do business with us, cool. You can't send business to Rocket anymore. Pick a side. And here's the part where people don't understand. People are like, that's anti this and anti that. And, the consumers should have a choice and brokers should have a choice. There's 55 lenders I can send business to. So you pick UWM and 54, or you pick Rocket and Fairway, who are the two they named, and the other 53. You still have plenty of choice. You just got to choose which side you want to be on, good guys or bad guys. Choice is clear for most brokers, 90+% of them that chose UWM. But if you chose Quicken and you're a fellow broker, more power to you, bro. Do your thing, man. You've still got 55 lenders, so don't say that UWM limited your choice. They just said between these two, you got to pick. And then you get the other 53. Home Point, and Caliber, and Remen, and all those ones. You still have unlimited choice as a broker. Well, not unlimited. Limited to these 54 or these 55. However you slice it, right? Whew. All right, that's enough. Yeah, I wouldn't mention the YouTuber. I mean, if he's putting out information like that, he's probably got other kooky get rich quick schemes, because there's that whole escrow claiming thing, not legit. My cousin was forced to buy a car, so FICO took a brief nosedive. A 4-month-old trade line still result in a rejection? I'll look at your follow-up question, and this one should add some clarity. Can you please outline what you're seeing as the primary reasons for DU reject and or refer in 2021 as compared to previous years, besides the obvious? This is a great question. And for anybody who doesn't understand what DU is desktop underwriter. So as a lender, I've got your credit report. I've got your monthly income that we've calculated. I've got your debts. I've got everything plugged into a system. And then $400,000 purchase price, 5% down, we plug it in. It's going to kick out an approve eligible or refer with caution, or it won't approve. God, I can't think of the verbiage right now. But anyway, approve eligible or approve ineligible are the two main findings we get. And if I can't get an approve eligible through the automated system, I can't get a loan done for you. So we've got to put more down payment. We've got to pay off some debts. We got to do something, right, to get this thing to approve. And what Mona is pointing out, which is a great point, Fannie and Freddie, who run DU, Desktop Underwriter, and LPA, Loan Prospector. Is that what it is? Man, I'm getting old. DU and LP, those systems, they can change. And you can plug in the same loan today that you plugged in 3 months ago, and it gets a refer or an approve ineligible today that was approve eligible 3 months ago. And so Mona's asking, what are we seeing as the primary reasons for that? And what I can say about this, Mona, is that the debt to income ratios are getting stricter. On the front end, if you're above 38%, 39, 40, it's hard. And it's a collection of things, right? You've got a 720 credit score, you've got 5% down, you got a 37 front end and a 44 back end. I'm not seeing a lot of stuff over 45 approve eligible unless the compensating factors, the credit is amazing, the down payment is good and whatnot. And so it's getting stricter. There's not specific stuff that I can point to except for that it's getting stricter, right? And when I talk about debt to income ratios, for anybody who doesn't know, since I'm trying to educate folks and help folks understand it, your income versus the mortgage payment is the front end ratio. Your income's $10,000, your mortgage payment is $3,600, 36% front end ratio. Then you put the car payment and the student loans and the credit cards, and that total with that mortgage payment is $4,450. That's the back end ratio. So you've got a 36 or whatever I said, 36 front ratio and a 44.5 back end ratio, because your total income versus those debts determine that. And DU, the automated systems, is looking at the front and the back. Because some people say, oh, it's under 45, you're good. Not necessarily. If you have zero debt at all and your front and your back are 44.5, DU might not like that front end to be in 44.5. A lot of times DU wants the front end to be lower than 40 and the back end to be less than 45. Sure, you can get stuff approved up to 50, but it's probably a higher down payment. It's probably a better credit score. All right. Thank you for the happy anniversary. 13 years she's been putting up with me. Can you help determine if we are qualified for a loan if we feel like we are borderline above the DTI requirement? Are there loans available for people with high DTI? Generally, depending on how much money you're putting down, if you're like borderline DTI, you might be forced to do FHA. And I've seen that come across my desk more often than not, where someone's putting down 5% conventional and we're like, man, you're just, you're 41, 51 or whatever the debt to income ratios are. This isn't going to go conventional. And, maybe in that scenario, we look at if we pay off a debt or two, then we get to 41, 48. If it still won't approve, we can look at all kinds of scenarios. And I've got really great team members that say, all right, Matt, we've looked through it, we've combed through it, we've scrubbed this thing as much as we can. Even if we paid off all this guy's debt was 41 over 41, DU still doesn't like it because the front end's too high. Okay. Then we look at running it through FHA. And FHA is just more flexible, is going to be more flexible on debt to income ratios. That's really your only option. There's not like a separate program that has more flexible debt to income ratios than that. So that's the only thing. And, this is another case for super, super important and a super good idea. Find a mortgage broker you like and trust, get them absolutely everything. And so they'll be able to run these numbers for you and tell you just, this is exactly what you qualify for, Justin. Here's what you qualify for if you did 5% conventional. Here's what you qualify for if you did that same 5% or maybe just 3.5% FHA. And then go from there. And you can decide what you want to do. Wait until you make more money so you qualify from conventional, or buy something now, FHA. That's where you want to start. Get some good advice from a good broker, exactly what is available for you, and then game plan to do something in the future or now. Good evening to you as well. Thanks for joining. Thanks to everybody who's on here. Really appreciate all the questions. This is the best part about it, is I don't come in here with anything planned, and I'm not going to read off a script. I'm not going to tell you guys exactly what's whatever. We're just freestyling. That's what I was trying to say. Sorry, English is hard for me sometimes. I'm in Kentucky. I have 3 single home rentals, total rental income $5,000 per month, all on my personal name with perfect credit. I owe a private lender $490 at 5% interest only. Not paying any principal down. The homes are worth $850 to $950. You did good, man. You did good. You're in a good equity position. I mean, you're looking at like 60% or lower as far as your loan to value. Oh, I thought you were going to talk a lending question. Now you're talking about, should I sell them? I think it depends on what you're going to do with the money. I think that rents, depending on the area, rents in my area are going up faster than home prices. And there's as much demand for rentals as there is for homes. And so we're seeing the same upward pressure. And I think I saw something recently about rental increases in Sacramento. And the same way that buyers talk about it being really hard to buy a home, renters talk about how hard it is to rent a house. And so I'd first look at that and see if your thesis is true, that like home prices are going to go up faster than rentals. And then I would figure out what your game plan is long term, because my guess is that you bought these places as rentals. Maybe you bought them as a way to make some income short term. But here's the problem. Let's say that you put down payments, and so you paid $600 or $650 for them because you owe $490, and now they're worth $850. You're going to sell. You're going to pay capital gains, depending on your income and capital gains and all that other stuff. What are you going to do with that money you're left with, right? Because you're going to be left with a pile of a little bit of cash, and if it's a couple hundred minus capital gains, and now you've got 140. Like what are you going to do with that 140? That's an important question to answer. What are your goals? Is your goals financial freedom through passive income? Because then you're going to look at, regardless of how you think home prices are increasing versus rents, if you've got 3 stabilized rentals that are kicking off $3,500 a month, I probably lean towards not selling. I'm more of a long-term hold kind of guy. And even though I could sell some real estate, deploy it somewhere else, you gotta also keep in mind, one, the selling costs, and I didn't even include that in that calculation, where it's like you've got the selling costs, you've got the capital gains tax. Once you whittle all of it down, then you got $100,000 to work with. Like, what are you going to do with that money? Versus let it sit where it's at. It's kicking off whatever it's kicking off, right? Maybe that's $25,000 a year in cash flow. Are you gonna want $100,000 this year after you pay taxes and selling costs, or do you want $25,000 a year forever and let them continue to appreciate in value? Let the tenants continue to pay them down. There's a bunch of fun math you can do with that, I think. So I would certainly watch that. Ryan Lundquist, man, it is cool to see you on here. If anybody doesn't know about Ryan Lundquist, SacramentoAppraisalBlog.com. I think I have, I've got Sacramento Appraisal Blog up in the background. Whenever I'm poking around looking for good information, that's where I go. Sacramento Appraisal Blog. Ryan's in my market. He does a bunch of cool stuff with real estate stats. So you guys got to check him out. He was on the live in the past. I know that I've had people request to have him back. He's an appraiser, so he's got a really good finger on the pulse of the market. And I appreciate the congrats on the championship. My 8-year-old and his farm league team won the farm division championships. Man, it was fun, dude. It's fun coaching those guys, and it's sad that the season has come to an end. But we won the championship on Saturday, celebrated it on Sunday. It was really cool. Really cool. Ryan, if you're going to stick around, man, I would love for you to throw some stats at us, dude, because that's always fun conversation. Here's what I'm trying to figure out is I could not find good information on like weekly inventory stats. And I don't even care if it's national. I'd love to hear Sacramento inventory stats because I just go off the cuff and I go with what I feel. I feel like there's more inventory. Something I found online told me that week over week we've got more inventory. But the national number, I don't even know what the increase was. It looked like it was 0.5% increase in inventory week over week. If Sacramento's gone from 2,500 to 3,000, something like that. I don't know. I feel like there's more inventory, but like most people, I don't want to wait until May numbers come out. I don't know if there's any way to get real time. Maybe I got to get my access to I've got my real estate license. So if I wanted to, I could plug into SAC Association of Realtors and the MLS, and maybe in there I can find some better stats. All right, Perry, if I had 3 homes worth $900, how much rent would you anticipate to receive from them if you're just looking to buy them? I mean, this one is dependent on market, but if they're single family homes, I'm not a big believer in like that whole 1% rule where it's like, oh yeah, they should be getting $9,000 in rent because it's $900K. But if you've got good cheap debt on these things, I guess you got 5% and it's interest only. So I wonder how that would look if it was amortized at 3% and you were in a mortgage where you're actually paying the debt down too. I think that 5 or 6. Oh, total rental income of $5K. Yeah, so you're getting $5K, and your thought is like, take this money and deploy it elsewhere to get a better return. You owe $490. If you refinance that, yeah, I guess if you refinanced it, like with property management and with all costs, like what's it going to spit off? $1,500 a month. If you sold, you'd put $100,000 in your pocket just for conversation's sake. So that $1,500 a month after everything's paid, that's an 18% return on that $100,000. That's how I look at it. I'm not looking at it as like $900,000 worth of stuff is paying this much in rent. Here's my cost. Here's my monthly cash flow. If I sold and took that money, it's like the opportunity cost question, right? Is like, what could it do if I redeployed it? I think that that's what comes to mind for me for how to think about that. If your net taxes and all that is going to be $100,000, and your choices are the $100,000 or the $18,000 a year in net rental income minus all expenses, I'd leave it alone, man. That's 18% return. I don't know where else you're going to get it, and stable real estate with fixed rate mortgage on it that they're when you take into account principal pay down and appreciation, it's better than 18%. That's pretty solid, dude. And those numbers are just me assuming some stuff and whatnot. So maybe the numbers are different. Maybe it's 14% or 16%, but it's good in either case, in my opinion. Yep. The rental market looked into Thomas. I mean, anywhere around here, I know for sure, Justin, I'm in some of the Sacramento rental Facebook groups and stuff, and people are just having a hard time. All right. Ryan's going to hit us with some stats. I appreciate it, brother. 1,600 listings right now. And I'm guessing this is Sac County. About 90 days ago, we had 1,200 tops. All right. Weekly stats aren't always easy to pull. That's fine. As long as we know like that's the active listings right now. It's up 33% from 90 days ago, which would have been like February. And so that's a good sign. I feel like it's coming. I feel like even more is coming. Normally we should have twice as much. So normally I'm guessing you're saying we should have 3,000. Well, maybe we see another little uptick here, and in June we got 2,000, and we won't be too crazy. Yeah, no, I get you. They just get into contract real quick. I wonder what the days on market is for our region recently, because yeah, it's the problem is 7, 9, 11 days after it goes on, it's already in contract. Ryan, I don't know where you're at or what you're doing if you're in your home office, but if you want to join and chat live, I'd be happy to have you. I'm probably going to go until about 4:30. I'm going to cut it off. So totally up to you. And let me see here. I don't even know how to do this private, but that's the link. How do I? Yeah, I don't know how to share that in private chat. I'm not very techie, guys. I'm really not. But yeah, join us live if you can. If not, no big deal. $700 medical derogatory hit my credit. Disputed, and it was removed from TransUnion, but not Experian or Equifax. Scores range from 730. You know what? The medical stuff, there's so much medical that's incorrect that I think last year sometime, or maybe even it was 2019, lenders just disregard medical derogatory. Like it literally will not affect you at all. So that's the good news, is that regardless of where it's showing up, TransUnion, Equifax, lenders don't care. And your score is kind of indicative of that it hasn't hurt it too much. Like your mid score in there might be 750. You're going to be in good shape. I see this, Justin. I see more coming back and a few price reductions. Ryan will probably back me up in saying that the price reductions on stuff that was overpriced to begin with or was ugly, buyers are not as inclined today as they might have been in the past to look past all of that. Look past the fact that like this thing should never be listed at 600. It's not, turnkey ready and all that stuff. That might have worked back when there was only 1,200 listings and somebody could just put it up at any price and in any condition, and people would just like, okay, fine, and offer $595 on it. Now buyers are being like, nah, like, and looking past it, and people having to come back and reduce the price on it. I've seen that happen on a few different homes where I knew when it got listed at $589, I'm like, guy's out of his friggin' mind. And not in all cases, right? People, just because I think it's priced crazy doesn't mean so. Ryan had a good article, I think it was last week, on, you can price high demand stuff higher than you might think and still have plenty of action on it. But the stuff that's coming back or it's getting reduced, in my opinion, is the stuff that's overpriced to begin with, unrealistic sellers and or agents, and not, doesn't show well. Days on market is 12 days. Holy moly. Man, the median is 6 days. All right, you're getting out a report. Fair enough. Ryan's got work to do. Bunch of private appraisals. I appreciate you getting out those reports in timely fashion, even though I wish all the appraisers that were working on the panels where I order stuff through had the same sense of urgency. I don't think so. They're busy though. I'm not gonna pound on appraisers, Ryan. I'm not that type of guy. National price reductions are way down lately. Huh. I wonder if we'll start to see more of those, because I feel like that might be something that is coming, as like a lot of people are late to the party, and the best agents and the most like in tune folks kind of have a good feel for it. But as more inventory hits, this is just one man's opinion, one mortgage broker speaking on behalf of only himself, and just my opinion. As more inventory hits, and the not consensus, but the feel with a lot of people, at least in my circle, is that, like Ryan showed, 1,200 3 months ago, 1,600 now. Next month or 2 months, as more stuff hits, people are more comfortable letting people in their house, fully vaccinated, economy's reopening, whatever the case may be. If we see more inventory, I think what's going to happen is people are going to come, they're going to be a little bit late to the party, price a home as if it's still a market where there's such small inventory that every single listing is going to get a ton of action. And they're going to realize, like, oh crap, I listed it here based on how little inventory we had 3 months ago and how much, the supply versus demand ratios were off. And then they're going to be forced into a price reduction, or it might sell a little bit below that list price. I don't see a fast turn of events happening, but there's going to be cases like that for sure, where people are just not really in tune with the market well enough to know where to price it accordingly. Slows for the season. We shall see. Yeah, it's going to be an interesting summer, because I think, some of the stats that Ryan shared and some of the stats that I've seen with seasonality is that the real estate market still has its regular seasonality to it, just a little bit less so in the last year. I think about my personal life and what other friends and family have kind of gone through, and there's less of like a defined school year where kids are in school, and then summertime is the time where everyone's going to move because they don't want to do a move during the middle of a school year and disrupt their kiddos and all that other stuff. With students working from home and schooling from home, and some of them now are hybrid, where it's part in the school, part at home. It's kind of changed that a little bit, but the stats still show, and Ryan, correct me if I'm wrong, there's still the normal seasonality in real estate, where spring is super hot, summer, there's action, and then fall it slows down, and winter it's slow. Kind of how real estate has always worked over the years. And then, COVID throws a monkey wrench, and, probably a more active fall and winter than ever before, because people who maybe started their house hunt in the spring or summer realize, like, holy moly, I wasn't able to get anything. So they were still shopping in November and December. At least for me and my business, the clients that I had a client get into contract this weekend. Hallelujah. It's been looking for probably 9 months. And I'm not talking just looking, I'm talking about offering in multiple zip codes. And thankfully got an offer accepted. Great family. Super, super stoked to have them finally in contract. But I'm sure there's plenty of that all over the place, where people are less focused on the timing of the move based on a school year, based on that, and more focused on just, I'm trying to buy something in 2021. I'm gonna buy it, close on it whenever the heck I can get something accepted. Yeah, I don't know how many are really falling out, Justin, because most offers had something in there about the appraisal coming in low. Any agent who had any sense was reviewing offers with their seller and recommending. I mean, from everything I saw and all the offers my clients were putting in, if you didn't have something in there that talked about what happens if an appraisal comes in lower, you weren't going to get an offer accepted. And it makes sense. If I was a listing agent and I was working with a seller and I got a ton of offers, you could offer me $1 million. If that $1 million offer didn't have anything in there about what is going to happen if the appraisal comes in low, then that $1 million offer doesn't mean anything to me. And so I haven't seen a lot of fallout because of that, because 460, 480, 490, one is going to bridge a $20,000 appraisal gap. One's going to bridge $30,000 appraisal gap. One is going to just waive the appraisal contingency altogether. That was kind of already negotiated up front. And so there's hopefully not agents and buyers submitting those offers that can't actually perform. I mean, and I've seen totally justified more grilling than ever before, which I appreciate because let's vet it all up front. But when I talk, what I'm talking about is I'll have an agent who I call, hey, it's Matt. I'm calling on 123 Main Street. I just had realtor Josie Smith put in an offer for the Lundquist family. And some of the questions that they're asking when I'm saying, hey, they're well qualified, W-2 income, they've got verified money in the bank, great credit. I've already done the verification of employment and we know exactly what we're going to use to calculate the income. This is a sure deal loan, right? This is the kind of stuff I'm communicating to the list side. Their question is, I saw that they wrote in here that they're going to bridge the gap up to $30,000 if the appraisal comes in low. Can they do that? And do they know what that looks like for them from a loan perspective? Which is a great question, because whenever someone's putting an offer in like that in a competitive market, what I try to do to help out both realtors, buy side, list side, is really show the buyer what that offer means. Okay, so you're writing this offer, great. I'll show you what it's going to look like if it comes in $30,000 light, $15,000 light at value. So it's not just like, hey, I'm going to offer $30,000 above ask because that's what it's going to take to get accepted. It's, I understand what more money I'm going to have to come out of pocket, or maybe I lower my down payment and that's how I bridge the gap. But now my payment is higher. Whatever the different, the appraised values, however that's going to affect them, they should see it before they submit the offer. And so I'd like to think that a lot of lenders are doing that. A lot of realtors and lenders are having that conversation before it's going into contract. Because if not, then this is what's going to happen. It's going to cause an issue during the loan where the buyer goes, no. I'm not coming with an extra $30,000 out of pocket, or I'm not going to put 10% down and bridge that $30,000 and now have mortgage insurance that pay $300 more per month. If they weren't explaining that up front, I could see how buyers could get cold feet and be like, no, I'm out. I made some videos on that, and I've had enough conversations around it where I feel like any buyers that I work with that are submitting offers know and are fine with, or else they're not going to write the offer, the scenarios if the appraisal comes in light. No updates yet. Wolver G01 40-year refi. I think it's coming. We talked about it earlier in the live stream, and it's being offered to people exiting forbearance. 40-year refinance, lowering the rate, different types of loan modifications. And the CFPB made it really clear they want servicers to give people options. 40-year loans being one of them. And I've got real proof of real clients that were offered that. And we kind of analyzed it and analyzed what the servicer was offering. I was like, do that for sure. I mean, this client was trying to get out of forbearance to refinance. And I told him, go with the loan mod. Loan mod's better than getting out and refinancing with me. So that was that. Is there a way to compare a builder's lender with a $6,000 credit closing to a mortgage broker without doing the entire pre-qualification? Usually, I mean, not even usually, always. If you were in California, Chris, you could literally get an estimate from this builder's lender, send it to me, and say, Matt, my credit score is 762. And if the builder's lender hasn't told you what your mid credit score is, you can just ask them because they've pulled credit to do this. My credit score is 762. What would a loan look like with you and one of the people you could broker this to? And I've done that in many cases, and I've been super honest with people. Sometimes I do it, and I'm like, man, use the builder's lender because my pricing is equal, except for you're getting $6,000 credit, and they won't give it to anybody. They'll just only their lender. You know, if it's Lennar, they own Eagle Home Loans, and so it's their own company. They want to keep it all in house, and whatever their reasons are for that is fine. They might just be better to work with them. I had a buddy who I had to force him to use the builder's lender because it was a better deal. And then we came and we refinanced later. But yeah, you shouldn't have to do the entire pre-qualification. In general, if you're just looking for pricing with your credit score, your down payment, you should be able to get a good idea on pricing. I mean, I could pull pricing in 2 minutes. I'm not going to put together Excel spreadsheets and all that for everybody in California because I just respect my time more than that. And so I don't want to open myself up to like 90 people a day being like, you know, hey, Matt, here's what I'm doing. But, you know, if you were in California where I do business, and you're like, hey, I'm thinking about using a mortgage broker and love to use you. I just want to see what it looks like side by side. And you sent me what they're doing. I'd be happy to just tell you based on that, you're in good shape. Stick where you're at. Or, yeah, they're giving you a $6,000 credit, but I can get the same rate and give you an $8,500 credit. Sometimes it's been like that. Recently, I'll tell you, like the builders lenders have been pretty sharp. If I was giving you honest feedback, I would say that like 80% of the time recently, I'm just like, stick with them. Good. Last year, it might've been like 50-50, like half of them that were coming to me. I'm like, oh my gosh, like this rate that they're giving you, I can get you $11,000 credit from the lender. Because it's a sliding scale where, you know, if the builder's lender is offering 3.375, I'm like, wow, you know, I was going to offer you 2.875 at the 3.375. My credit is 7,700. But I don't know. I feel like they've got more competitive. Who knows? It's a moving target. There's different lenders that are partnered with different builders. The builders that own the lenders generally are sharper. I think that's Lennar and Eagle. There's some builders that for who knows what reason partner with like Wells Fargo. They like their stuff to go slow. When paying for points to reduce a loan rate, can we change our mind on paying for that points? Oh, for sure. This is like a change of circumstance that takes all of 5 minutes for the lender. So if you're working with somebody and they're telling you that's going to delay anything, here's what happens when I'm working with somebody, Justin, and it sounds like, depending on whether this is refinance or purchase, it's the same. But let's say that you're in contract to buy something and we got you set up at 2.875 and you're not paying any points and you're locked. Locked or not, this doesn't matter either. You tell me, you know what? I'm going to get a $6,000 check next week and I really want to have a lower rate because I want to make sure my payment is comfortable. I can show you the whole rate sheet that goes probably down to 2%. And going from 2.875 down to 2.625, depending on the loan amount, might cost $6,000. And then I just present it to you and say, yeah, if you want to move to 2.625, it costs you $6,000. It saves you $52 a month. You decide, like, do you want to spend $6,000 to save $52 a month? That's like a 10-year break even. Or, maybe it's $100 a month. I'm just throwing out random numbers. You tell me yes, and it's like a change of circumstance. It changes internally with the lender. No, like, no change to the timeline. The only time, here's something I just thought about. If for some reason, like the paying points to get the lower rate, it sounds like you've already got set up like that. If you're like, hey, I don't want to pay points anymore, I want to go back to whatever their par rate is, no points. If you have to pay the points to get the lower rate to qualify, then it could mess things up, right? But assuming that's not the case, yeah, you pick whatever rate you want and you change it once, and then you decide, you know what, never mind, I don't want to pay that. Like back to 2.875. Simple change of circumstance with any lenders, I would imagine. So, yeah, just look at that too. I think we went over that last week with somebody on here, where every lender is different, and it really like ebbs and flows and changes daily with how much it is between each rate. One day it can be a half a point. Next day it could be 3/4 of a point, depending on, what's going on the back end, the lender selling it, whatnot. But let's just say 2.875, like I said, is your par rate, 0 points. And then 2.75 cost you 3/4 of a point. 2.625 cost you 1.5. Really look at what that cost is versus how much it saves you per month. And if it's more than like a 5-year break even, I would really think twice about it. Saving $52 in year 7 in 2028. I don't know if you want to spend $6,000 of today's $2021 to be saving that money. You're basically banking on the fact that, one, you're going to stay in it that long, and two, those $52 are going to mean even close to what they mean in today's dollars. That's just my one man's opinion. NMLS number 1088993. This is a good question, Caesar. Thanks for joining. The reason why it's hard to calculate what the amount of PMI will be, at least on conventional loans, is because it varies by lender. And as a broker, I know that if I send it to a big company like UWM, who has a little bit of leverage to get the best mortgage insurance in the country, it's going to be lower than if I send it to another lender. And depending on, if you're working with a bank, you're working with a direct lender, you're working with a broker, it's going to be different at all of them. And the only real, if you're doing a FHA loan, you can know that the factor is 0.85. So if you do $300,000 loan times 0.085, 300,000 times 0.0085, and that's $2,550 divided by 12. It's $212.50 per month. That is how you figure it out for FHA. For conventional, if you've got a 760 score or a 720, if you're putting 3% down, if you're putting 5% down, all those fall into different buckets. And you can have really, really low mortgage insurance. If you put 15% down, you got a 780 score, the mortgage insurance is going to be $20. If you have a 690 credit score and you're putting 3% down, mortgage insurance is going to be chunky. So that is a moving target. Mona has a follow-up question to that. You can ask the lender to shop your PMI. Yeah, certain lenders are going to have, there's tons of different mortgage insurance companies. And so if you work with a direct lender, or maybe the banks do it like this as well, they're going to have these 9 different companies that they can shop. And, UWM does it different because they're huge and they've just got their own PMI contracts that are lower than any of these companies. But if I send it to Home Point or somebody else, then, they're going to have, different prices at different PMI companies. So yeah, this is true to a certain extent. I don't know how much difference you're going to find. Like back when I was a direct lender, I could look at, or some of the PMI companies like Genworth and, I can't remember the names of the different companies, but sure. Yeah, they're going to be different. And then, yeah, depending on your bucket, right? Credit score and down payment, you can find $97 a month mortgage insurance versus 104, something like that. Just call a local mortgage broker. Non-QM, Al, is something that is not a qualified mortgage by, I can't remember what regulatory agency's standards it is, right? But it's, they play by their own rules. It's non-QM is almost like portfolio stuff where, the bank statements loans, the debt service coverage ratio loans, those are just a totally different thing. I made that non-QM video. Those things are getting more and more popular. Jumbo is going to fall into the QM category where it's like a qualified mortgage. It's not conforming because conforming loans is just under a certain loan limit. 548, 250 is like the conforming loan limit across the U.S. And then certain counties like, the Bay Area and Southern California might have a 822, 375 cap, and that will stay in that conforming. And then above conforming is jumbo. Hopefully that clears it up a little bit. This is a super, super common question. And myself as an investor dealing with investors, always this question comes up. They want to purchase a home in a trust. They want to purchase it in an LLC. The short answer to this is not usually. Usually, most lenders, especially getting a conforming loan and the lender's going to sell it to Fannie or Freddie, you've got to be a personal guarantor, whatever the fancy verbiage is for it. And so the loan's in your name, your credit is getting pulled, you're signing for it. You transfer it to the trust, you transfer the LLC as soon as you close it. And title companies used to do this. I think that some rules have changed where they're not necessarily allowed to. And so, yeah, now it's more going to be done by a deed company. In my area, we got sacdeeds.com. They're great. They send out a mobile notary. Al Bundy wants to transfer it into the Bundy 2021 trust, or whatever the case may be, or your Bundy Rentals LLC. That's something that's done after the fact. But in order to get a home loan in the name of LLC, or some people are trying to do it like the LLC or the trust is going to be purchasing it, way more difficult. It's going to be some sort of non-QM product where you pay a higher rate and higher fees. So that's the quick answer. Can you purchase a home in a trust? Yeah. Just transfer it to the trust right after you close it. Once it's in the trust, you can refinance it and keep it in the trust. That's what happens quite a bit too, is people want to do that. And we just need to have the trust documents, and the title company will allow it to remain in the trust. What else we want to talk about, folks? I think I'm going to go another 15 minutes. I'm going to cut it off at 4:20, doing dinner for the anniversary. So I got to get a few more things done in my business and then on the road. Fire the questions fast and furious over the next 15 minutes. I'll do my best to answer them. We can talk about real estate inventory. We can talk about where rates are headed. All kinds of stuff. How much do loan extensions cost? Every lender is going to be different, Al. I'll give you some really specific examples. If you know what basis points are on a $300,000 loan, 1 point is $3,000, and 1 point is 100 basis points. And so 1 basis point is $30. I'm getting somewhere, don't worry. 300K, right? Every basis point is $30. A lot of lenders I work with will charge 2.5 basis points a day. So that's $75 a day. I can get lock extensions in a lot of cases for a 30-day period if rates haven't gone too much higher than when I locked it at, for 10 basis points. So on that specific $300,000 loan, for $300, I can get extended for 30 days. I've done a lot of those recently where I've had appraisals were taken long because it was in a county that was out of whack, or not out of whack, just not as, it was more rural. Not why I said out of whack, but appraisal was taking longer, had to extend, or repairs need to be done in a VA loan, had to extend. Sellers had an issue where they're trying to buy a house forward, had to extend. I was able to get 30-day extensions for 10 basis points. 10 basis points on $300,000 loan is $300. If it was an $800,000 loan, it'd be $800. So that's kind of how those work. Some lenders, you might get a 30-day extension for free. Some lenders, you might get 5 and 7 day extensions if you send them a lot of business for free. It kind of depends, but that's a few examples. And it's really like for us as brokers do with 50 different lenders, 50 different lock extension policies. How soon can someone refinance after purchasing a home? You could refinance right away. It would, you'd have to ask yourself why, because refinances cost money. And if anyone tells you any different, they're lying to you. There's, title fees, there's lender fees. And if someone's telling you it's a no cost refi, then they're just raising the rate and getting rebate to pay for those fees. But it would be a really weird scenario where you bought something and rates were low enough to justify paying those costs. If you bought something with the builder and then you realize afterwards, like, man, the builder gave me a 3.625. I didn't even realize I could get a 2.875. Then maybe, you refinance within those 6 months. So there's no rules around how long, but it's going to cost you. So you got to make sure that it's worthwhile. All right. Final call for questions. Give me what you got. I'd love to hear what you're seeing in your current market, what the kind of vibe of the room is. Because I feel like we got more inventory coming in Sacramento. I can just feel it in my bones. Even if we haven't seen the data yet, I can just feel it. I can feel it coming. I mean, just in the zip code that I'm in where I get updates. Let's do it, man. You want to do an interview? I'm game. Shoot me an email. Matt, M-A-T-T, at mattthemortgageguy.com. I'm all about podcast interviews, chatting with new folks. So Matt, M-A-T-T, at mattthemortgageguy.com. Myself or my Office manager will. I've got spots on my calendar now that are 45 minutes or 1 hour podcast interview stuff. So I'll be down. All things risky with Mikey. Let me check you out. All things risky. I'm trying to guess what kind of content that is. Risky with Mikey. Cool name, if nothing else, right? All right, I'm gonna check you out, man. Shoot me a message. All right, this is a great question, Nicole, and I appreciate you asking it. There is a 0.00 chance that we're going to see a correction, and for conversation's sake, let's call a correction 20 to 30% reduction in prices. I will bet this right pinky, and if home prices go down by 20 to 30% this summer, I will cut this pinky off right here, and I'll eat it. And here's the thing. It would really hurt to cut it off. I cut through the bone. I'd get a bunch of stuff on discount, so I'd probably add to my net worth. But there's just zero chance. Zero chance. Something ridiculously insane would have to happen with this market. And here's the thing. Even a slowdown is going to be, we've seen 8 to 10% price appreciation so far this year. I don't know what the exact number is, but let's just call it 10%. A slowdown, Nicole, is going to be 5% or 6%. So if home prices only increase by 5 or 6%, they're still increasing. I can almost guarantee you that if you buy a house next year, it's going to be more expensive than it is this year. Rates will probably be higher too. And so, I'm not trying to sell anything, and people will say, oh, he's a mortgage broker. He's got to say that. Real estate agents and brokers or whatever. 95% of the people that are watching my channel aren't in California. I can't lend to you anyway. So I'm not trying to get your business. I'm just telling you, human being to human being, I do not see any way that we can see any real correction where home prices are 30% less than they are now. There's just too much supply versus demand imbalance, and there's no quick fix to that. I don't know of any builders that can just snap their fingers and build 46,000 homes in California in 19 days. The amount of inventory we would need to get to a market that's stable, where maybe home prices are flat, is just not possible. If rates go up 1.5%, if rates go to the mid 4s, I still don't see it quelling demand enough to get us in a position where there's that supply versus demand equilibrium where prices get flat. I'd love to see it. I've got plenty of buyers pre-approved that I would love to let them operate in a market where there's plenty of houses to choose from. They can look at something this weekend, kind of think about it for a while. Then the next week, they can look at something different. And, this market we're in is unhealthy for everybody involved. I don't like it. My buyers don't like it. It is what it is. And so trust me when I tell you, I'd love for it to cool off. And cooling off is kind of the best we can hope for. Correction you're talking about is more than cooling off. Driving 100 and then slowing down to 50 is a possibility. Driving 100 and then going negative 60, going 60 in reverse is just not going to happen. Yeah, I appreciate the question. 22, 23%. Nope, not even 10. I don't even see 0 as a strong likelihood this summer. I see prices continuing to increase, but I've been wrong before. I'd have to be really wrong to lose the pinky. And then Ryan's going to let me have his cigar cutter. We'll put alcohol on it, so it's like, sanitary and I'm not getting infected. We'll go live together, Ryan. We'll do that. What if something crazy happens? I'm going to take this video down real quick. I'm not licensed in other states, Mona, mainly because I'm a firm believer in do one thing really, really well and, stay in your lane. As a mortgage broker, I could go get licensed in multiple states. I could do rehab loans. I could do construction loans. I could do reverse mortgages. I could do all that stuff. What I deal in, 1 to 4 unit, purchase, refinance, conventional, FHA, VA, my bread and butter. I do so much of that I feel like me and my team are really, really good at it. If I did other states or other products, it would just be a distraction and I would do not as well of a job as I do right now. I protect my reputation with everything. And I like to think that that's how it's always going to be for me and my team, is just do it really well. And really in Texas, there's some different rules with mortgage, with property taxes, with other stuff. In other states, I know just things work differently where you want a high level advisor. If I was trying to tell you in California that I know as much about Texas real estate and then, do my part as a mortgage broker there, it wouldn't be in your best interest. I'm trying to do right by the consumer, and doing right by the consumer, in my opinion, is just sticking with what I know best. So that's why not other states, but greatmortgagebroker.com connect you with the broker who's in your state. Where did that go? Boom, right there. And quick 6 questions. You'll be connected with somebody in your state. Good question, Mr. Texas. Mortgage loan modification requirements. I know that a lot of people who are exiting forbearance are getting presented with loan modifications. From what I hear, it's not a lot. I don't know what the exact parameters are. Back when I really dug into loan modifications in the last crash in 2010, they wanted you to show income documentation. I haven't heard it yet. I've had clients tell me that they've been offered stuff. I haven't got feedback on exactly what the servicer is asking from them. So if you're in forbearance, exiting forbearance, offered a loan modification, please send me that info. I'd love to hear about what's being required. And if I get that information, I'll definitely make a YouTube video on it, because I think a lot of people have this same question on what's going to be required. I think that for sure they're going to work with you. I mean, the CFPB's made it clear they have to offer stuff. The fact that you're in forbearance and exiting forbearance might be enough. And they just say, listen, we want to make sure you can make your payment going forward. We don't want you to have any issues. 40-year loan. Are you cool? And then from what I heard from a client, they got their rate reduced. They got extended to a 40-year loan, and they're going to do a 3-month trial period, make those payments. And then once that 3-month trial period is over, then they're officially in the loan modification. So give it a try. Let me know what you hear. Yeah, you're right, Nicole. San Diego, home price correction is about as likely as, I don't know. I don't have anything clever to say. No problem. Thanks for being here. I appreciate all you folks that are here. And we had some good attendance, even though we switched up the times on people. I was worried like, oh man, I'm gonna go 3 hours earlier and people are gonna be like, not tuning in. Next week and moving forward, 6 p.m. Pacific Standard Time. That's what overwhelmingly in the poll I got as a starting time that would be best for most folks. So I'm signing off here very shortly. I love the interaction. Thank you guys who joined so much for joining. Thanks for all the questions. And 6 p.m. every single Monday, please join. If you know of anybody who might benefit from it, they're looking to do a mortgage, they're a new loan originator looking to get some information on doing loans. I'm seeing plenty of those people show up in my email and on here. If you're a real estate agent, anybody who has any interest in the real estate market and mortgage, let's have some conversations. That's how we all learn. And so thanks so much for joining. Thanks for being here, Mona. Appreciate you. Can you renegotiate your existing mortgage rate without refinancing? Not usually. I think the only case I've seen of this, Mary, is if you're in forbearance and they're going to give you some sort of loan mod. But I shouldn't say, well, contact if, yeah, I've seen very few and far between this actually happen. So so my short answer is going to be, I don't think so. If it makes sense to refinance, and if you talk to somebody who you like and trust, you're going to know real quick, and you're not going to worry that you have to go through refinance, because that 30-day process or 25-day process, providing a few documents, baking in $2,700 in cost or $2,900 in cost when you're going to save $4,000 a year is a small price to pay for that $4,000 a year in savings. So depending on how much you're going to save, it might be worth a refinance. That's the better answer. I don't want to request it and then they deny me. You don't want to ask for a loan modification because they might deny you? No, when you're exiting forbearance, just say, what can you guys do for me? That's what they've been instructed to do. Let them lay out all the options for you. And then when they lay them all out, say, what else? What about reducing my rate? I mean, if that was me, I'd be excited to have that conversation. See what they're going to do for you. Bill, my man, thanks for joining, brother. Good seeing you here. All right, I'm signing off. I got some work to do, and then I got the wife to take out for the anniversary. Appreciate everyone who joined. Every Monday, 6 p.m. Pacific Standard Time. I'm here answering questions as long as you guys will have me. As long as you guys keep showing up, I'll be here. Thanks, guys. Bye-bye.